Hello, welcome. I'm David Adams. This is my 2013 quarter one market update. Hope your year 2013 is off to a great start for you and yours. So I won't waste any time here. Last time I did this video was right after I got back from my 3-week trip to India with Raymond James, which was amazing, and right before the election, so a lot has changed in one quarter. Additionally, my team started our new branch office with Raymond James in Franklin, and we couldn't be more excited. So lots happening, very, very busy, and now the overused phrase fiscal cliff is now behind us as we move on to the debt ceiling discussions, or debate, if you will, which will really be the next big wave of anxiety for investors and the markets. So let's look back. What happened since I last gave you my thoughts? So President Obama was reelected for a second term. The Bush tax cuts were made permanent, other than those for singles making over $400,000 and married over $450,000. So the wealthy was defined by these numbers, and they will now pay around 40%, up from 35% before. And this should really help support our government spending for maybe 10 days. And according to the Tax Policy Center, this will only affect about 0.7% of households, but I'll digress there. And let me just say this, that the upcoming decisions about the spending cuts are a much bigger deal, in my opinion, as more people tend to agree that the U.S. has a spending and a debt problem, much more so than they agree on how to tax the wealthy. And the capital gains and dividends rates also increased from 15 to 20% for that same for those top earners, and an additional 3.8% tax from the Affordable Health Care Act, or aka Obamacare. Okay, so automatic spending cuts go into effect, and the debt ceiling, all of these things have to be addressed by the end of this quarter, but don't expect anything to be resolved until the final hour or after. You should know better by now. So will they finally address entitlement spending and issues this time? I hate to be negative Nelly, but probably not. But ultimately, we need to balance the budget. The entire focus of both parties has been fighting over the taxation of these 2% of the wealthy population. And okay, once again, I'm getting worked up, so let me change gears here. There have been 5 questions that we continue to get from our clients and investors over and over. So I compiled these 5 questions, and I want to give my thoughts on each. Number 1 is, how will the fiscal drag impact growth? Number 2, how do you position your fixed income investments in a low yielding environment? Number 3, what is the outlook for equities in a slow growth environment? Number 4, will emerging markets still drive global growth? And number 5, Europe. Is this a value trap or is it an opportunity? Okay, so let's tackle the first question about growth and the fiscal drag, the fiscal drag, of higher taxes on the wealthy and the additional 2% payroll tax on all working Americans. So federal income taxes will rise for 77% of Americans because of that 2% payroll tax cut that's now expired. Consumers have been able to purchase more and have had room in their budgets, mainly because of the low interest rates and the lower mortgage payments, as I discussed last quarter on my video. And this really kept their debt ratios, or debt to income ratio, much lower than in 2007. More people today are making their last car payment than their first car payment, which is also another testament to this. But keep in mind that the return of this 2% payroll tax means that consumers are slowly starting to find out what their new 2013 pay stub will look like, and that they're going to be a little more skimpier than before. So they're not going to spend more than likely this excess money. This will likely cause a fiscal drag in the first half of 2013, and more than likely the second half of 2013, things will change as there becomes more clarity in Washington and they get used to their new paychecks. So according to the Federal Reserve, there's a lot of excess money on corporate balance sheets due to rebalancing and cutting costs, cutting jobs, slimming down, however you want to say it. But we aren't focusing on the private sector. The media, everyone, all of us are concerned about one thing, and that's the government sector. Okay, so keep in mind when you're looking at GDP, or gross domestic product, that the government spending only accounts for about 20% of the GDP, but consumer spending is over 70%. So again, with everyone focused on Washington, it's really the consumer that's ultimately going to get us out of this mess, and they just got hurt with a 2% tax increase. So you do the math. That's the issue. That's my concern. Now moving on to question number 2. How do we position fixed income in a low-yielding environment? For 30 years now, it's no surprise that bonds have returned about the same as equities. But according to Standard & Poor's, from 1958 to 81 or so, rates were rising. Bonds returned much less than stocks. And keep in mind, this is likely a scenario that we're headed into where stocks could and should outperform bonds. But where is all the money going right now? It's not going into equities. We all know that. It's going into bonds. So be wary. When it comes to bonds, I think you really have to, more so now than ever, have managers that can be tactical, that can go long and short, stay nimble as rates increase. The days of buying and just holding long-term bonds and forgetting about it are over, again, at least in my opinion. Now, the third question that I've been getting from clients is, how do we make a return on equities in this slow growth environment? Good question. I think to answer this, we have to focus on valuations. Large cap, as an asset class, for example, according to the research group FactSet, is 23% below its long-term historical average. That's like a 15 price earnings versus an average of 21. Now, keep in mind that most companies have cut their margins and are slim. And so we won't see more marginal growth going forward unless it comes from revenues, which, as you know, this comes from that same 70% of the economy, that is consumer spending. You hear that, folks? Get out there, spend money, but then also save money and invest. I know, it's a never-ending struggle, especially coming from your financial advisor. Now, there are 4 things that drive consumer confidence. 1 is unemployment. 2 is gas rates, 3 are stock prices, and 4 are home prices. And most of these aren't great. There's a long way to go, but as they say, it's hard to jump out of the basement window, so have a little optimism, people. And the only way to go is up, and we're slowly seeing signs of this. So let's look at home ownership. As I sit here in my own personal house, it's the lowest since 1990s, and that's with record low interest rates and rents that are higher than average mortgage payments. So I would guess that home sales will continue to rise, albeit slowly. And if we get confidence, we really could see an explosion of growth. So keep that in mind. Now, the next question I've been getting is, will the emerging markets drive global growth? Yes, absolutely they will. China is 1/3 of global growth, and it's incredibly cheap from a valuation standpoint, and near the bottom of its historical range, according to the MSCI. JP Morgan, who is a firm you all know, but who I spent a lot of time with from an economic outlook standpoint, they really forecast emerging markets to grow, whereas the developed countries, more of a slow and steady pace. And according to the International Labor Organization, urbanization in these emerging economies is huge. China in 2001, as an example, the average person made about $74 a month. Now it's about $348. Compare that to us, where the average person was making $3,000, and now that's around $3,800. So you can see a big difference in percentage increase between China as an emerging market and us here in the U.S. Now, as production increases, wages increase. And when emerging markets can afford more, guess what? They buy more. So remember, again, China being 1/3 of the global economy, this is a big deal. Also, the U.S. consumption for middle class is going down, and middle class consumption in emerging markets is increasing, and will continue to increase again as these wages increase at a much higher pace. So finally, the last of the 5 questions I've been getting is really about Europe. Europe was all in the headlines last year. Is it a value trap or an opportunity now for investment? Most of these countries are undervalued, something that we're watching very closely. But they're not necessarily there yet. They still have the fiscal crisis and the banking crisis. But remember, I talked about this before. The U.S., here we have a fiscal overlay that the European Union does not have, and that's Washington. We have that central mechanism. And so as a whole, we think the valuations are looking good for Europe. And they stated recently that they want to create this fiscal central mechanism overlay like we have in the U.S. And this really created some temporary stability, and probably why we haven't heard that much about Europe in the headlines. But they have 17 countries and 13 languages. We have 1 country and 1 or maybe 2 languages, and you see how much trouble we have, okay? Let's talk about Germany. German exports are 40% of its GDP, of which half go to the Eurozone. So let's think about Mercedes. They export about 40% of the cars outside of Germany. of which half of those go to the Eurozone. So if the Eurozone stops buying the Mercedes, that puts Germany in the same place as us in the Great Depression, where we lost 20% of our GDP. So Germany cannot afford to have the Eurozone fail. So everybody has a motivation to keep things intact. So we'll continue to watch Europe, but we really like the emerging markets and the middle class growth. We expect the U.S. to have a slow first half of this year, but a good chance of some growth later in the year. And in my opinion, a low probability of a severe recession. And I expect there to be some volatility around the Washington debt debates and probably a correction during the first half of the year, which would be a great time to add any cash or dry powder, if you will, if it fits your risk tolerance. A couple of other points to mention. The Federal Reserve says its target interest rate will stay low as long as unemployment is above 6.5% and inflation is projected to be more than 2.5%. So we'll probably see that for a while. Since World War II, never has there been year-over-year government spending that decreased the following year. This may be the first year that breaks that mold. And never has there been fiscal tightening with this high of unemployment. Will there be this year? Maybe. Will the U.S. get more downgrades on ratings? Does it even matter? Last time it sure didn't, as money poured into U.S. treasuries. So some interesting times ahead for sure. But let me just say this in closing. Remember that there are more important things in life than money. Focus on your family, your hobbies, your spiritual walk, and certainly your health in 2013, and make this an amazing year. Let us worry about managing your money and your long-term plan. And until next time, next quarter, take care.